Please welcome our panelists, founder and CEO of Flagship Pioneering and co-founder and chairman of Moderna, Noubar Afeyan, president and CEO of Franklin Templeton, Jenny Johnson, CEO of GIC, Lim Chow Kiat, president and chief operating officer of Goldman Sachs, John Waldron, and our moderator, anchor for Bloomberg Television, Haslinda Amin.
Good morning. Let's talk about risks. I know, right? Where do you even begin? We're seeing a confluence of risks not seen in decades. High inflation, high rates, the end of cheap money. That's also geopolitics. It's not just about Ukraine anymore. It's also about Israel and Hamas, that simmering tensions between the US and China. We doubt much can be achieved at that meeting between Xi Jinping and Joe Biden later this month. There's also climate change. The last 8 years have been the hottest years on record. And of course, there's technology. So much buzz about AI, it's boon and bane. So what does it mean for investors? What does it mean for capital flows? And more importantly, how do you get capital to go to where it's needed? John, let's start with you. It's such a challenging environment, and it's getting complex by the day. For you, what is the key issue that's making it terribly difficult for investors?
Well, you highlighted the challenges and the risks that kind of permeate.
But what's key for you? What stands out?
I would say inflation. I would say inflation is still, to me, the single biggest risk. Certainly to economic growth, to purchasing power, to the deployment of capital, and then if you think about how perverse inflation is for those who are less well off, that has a very negative effect on prosperity, lifting people up out of poverty, or even those in the lower middle class that are trying to rise beyond the lower middle class. It's just very perverse for that category, which is in essence what all of us are trying to do in terms of driving economic growth to lift more people, into the system. So I think inflation is far and away the biggest concern, and I think the geopolitics that are now overlaid in a much more profound way. In many ways, you could say that the peace dividend we've had for the better part of 25 or 30 years is kind of over, and we're entering, unfortunately, perhaps a new era with more geopolitical tension, more war. More challenge that I think is going to make it even more complicated to create more economic growth. I think the impact that could have on commodities, as an example, can have more perverse impact on inflation. I think that the supply chain resetting that's been going on in the world is generally inflationary. The transition from just-in-time, globalization-oriented supply chain, where you were running one global supply chain where you wanted access to your supply when you could have it. Now there's more focus on resiliency and duplication and moving supply chain to the various places. That's generally, to me, an inflationary impulse. ESG and renewable energy and decarbonization, all of which we need to be investing in, generally have inflationary implications. If you think about some of the subsidy policy that's going on, whether it's the IRA in the US or other policies around the world, that generally has an impulse to drive inflation further. So there's a lot. Wages, still pretty tight labor market, that has more of an inflationary impulse. And I'd say the supply of oil, which is generally constraining, has been constrained, also has a positive implication towards inflation. So we spend a lot of time at our firm worrying about the longer run implications of inflation and how they generally will probably create a lower growth environment for us for a period of time with lower purchasing power capabilities, particularly for those that are less well off.
Jenny, inflation and that journey to 2% for the Fed, the markets were quick to conclude that the Fed was done and then change its mind. Was the Fed right in standing pat?
I do think the Fed was right to stand pat. I think that, though, the journey to 2% is going to be a lot more challenging. And I would just add on, so I completely, like John, really leave a couple things for the rest of us to talk about on the risk, okay?
He says he's paid to worry about everything.
But so completely agree with all the points that John made. I would just say the other challenge that I don't think gets enough, and you're starting to hear about it more, is, you know, even if the Fed is able to slow the economy such that it gets inflation lower, there is this issue of just supply and demand for U.S. treasuries and U.S. debt. I mean, the reality is the U.S. has gone from $7 trillion or $9 trillion in 2007, $31 trillion. We're going to add $2 trillion more. You have to have buyers. Now, there'll be buyers. The question is, at what price will there be buyers? And then, one, how much does that crowd out other investment opportunities? And two, you know, does that mean higher for longer, which I tend to feel like that is an issue. So I think along with the inflation, even if the Fed does their job in trying to slow it down, you know, they don't control U.S. spending, and that debt, I think, is adding a challenge. So things like, I mean, one thing we know for sure is that what we've had of this last, you know, peace dividend, but basically low interest rates, where were you going to put your money? Well, you put your money, you didn't put it in fixed income because you didn't earn anything, so you put it into equity markets. So, you know, equity markets took off. Well, now all those growth companies that really drove the equity markets, and same with this year, those earnings have just gotten a lot more expensive. You know, if you can earn 5% on cash and you're waiting for future earnings, chances are you're going to have a compression of some of those multiples. So I think that's a longer story that's going to be harder and harder for the Fed to actually control.
Chow Kiat?
Sure. Well, first, great to be here. Indeed, I mean, John has articulated quite a lot, Jenny as well, about, you know, all the negative headlines. Lots of challenges every day, right? When you read Bloomberg News, you know, newspaper, you see a bunch of that. When you go to conferences like that, everybody talks about all the problems. Maybe I'll take a slightly different take. You ask risk, the other side of risk is return. So perhaps, you know, if you sort of wear more of that cap, you know, Jenny talked about, you know, treasury bond or cash yielding more. That's a positive thing for investors. In fact, I would say, you know, look at U.S. tips, right? U.S. 10-year tips is yielding a real yield of 2.5%. We haven't seen that for a long time. It was negative. That means you actually get inflation-protected return guaranteed, right? Because I believe the U.S. government is rock solid. For 10 years, you clip, you know, 2.5% above inflation. That's very attractive, I would say, and that's actually great competition for a lot of other asset classes, right? If you were to take additional risk, you have to expect a return higher than that level of 2.5 real. So that's one, you know, way to look at it. Generally, asset use going higher should be good for long-term return. The second is even in fragmentation, right? We talk about fragmentation, geopolitics. You could see opportunities. There you see it in some of the beneficiaries of this supply chain reconfiguration. I think this region is a big winner. India, Mexico. So there are spots or industry where you can benefit from the reconfiguration. Maybe third, even in problems, right? We talk about climate change, big problem, very daunting. You can see opportunity in, say, energy transition. We need, I mean, according to IEA, we need something like 4.3 trillion a year to sort of have energy transition done with enough capital. Estimate last year 1.8 trillion. So 1.8, 4.3 is a big gap. So I think actually for investors, that's an opportunity as well, right? That there are more and more projects, more and more companies going through transition that you can deploy large amount of capital, right? 4 trillion a year. So I think from that angle, I think if we can kind of tackle it from a solution point, opportunity point of view, you know, I think we can move forward.
Chow Kiat sees the opportunity, so do you, yeah? Noubar, I mean, for healthcare, for instance, a risky environment and certain environment is a great environment for healthcare. So you should be thriving.
Well, yeah, so first I should say that I guess I'll be the diversity representative here because I come from a very different world, which is a science-based industry. And for us, these concepts of uncertainty and risk, et cetera, are in fact what we try to create. In fact, when you have new technologies and new insurgents, they thrive on uncertainty. They don't do so well in risk because they can't really mitigate or hedge that risk because we don't have the resources often as small companies. So I would just say, just to offer an additive perspective to what I've heard this morning and here, which is, I came into my room yesterday, the Bloomberg cover said, instability, et cetera, these words. I think that we're at a moment where we're kind of being increasingly suffering from a series of pandemics. I come from a world where we worked on a pandemic at Moderna, and we think that a pandemic means a disease that afflicts the planet. But actually, literally, a pandemic means anything that afflicts all people on the world, essentially in a negative way. And so think about what's happened. You have a pandemic, a health pandemic, that led to a financial pandemic, a supply chain pandemic, a geopolitical pandemic, a war pandemic, a misinformation pandemic, and then you have the climate pandemic waiting to get its chance to really have a big impact. And so what has that done to our general notion of economic equilibrium? Well, it's made it laughable, I think. And in nature, these things happen. It's called punctuated equilibrium. And I think we should really start thinking about, and I heard a little bit this morning, when will it go back? The people who wanted things to go back are the incumbents. Insurgents want it to go forward because in the back, they really don't have a role to play because they're dominated. And so I think what you're going to see in this environment is the appearance of a different and new equilibrium state. It's very scary because obviously investors value predictable, profitable growth. There is no predictable, there's hardly any profitable, and there's hardly any growth. And so how do you actually make decisions? You go revert to what you're used to. And I think that's going to be very interesting. And the last thing I'll say is, in biology, in science and nature, these things happen, and there's a lot to be gained out of looking at that. And the big thing to gain out of it is that thinking of that change as a matter of risk versus thinking of it as uncertainty, meaning this morning I heard embrace the uncertainty. You can't hedge uncertainty because you need signal to be able to do something. In uncertainty, there is no signal. Uncertainty is about unknown probabilities. What you can do is resolve it, which is take some steps, do some experiments, and if it actually resolves and it turns out it's going here, then be the dominant player there. So I'll say those are all the ways in which we see in health, but also in the scientific world, uncertainty is an opportunity. Last thing I'll say is that in dramatically changing times, that's when new technologies have a slight crack to actually matter. E-commerce, certainly AI now, the vaccine. So if you think about it, the technologies underlying the mRNA vaccines existed for 10 years. But the moment in which it actually became possible to do this at a global scale actually was as a result of crises. And the question is, what opportunities is the climate going to present? What opportunities are these current moments of massive shift going to present? And I think that's where entrepreneurs and innovators have to realize this is not the time to actually retreat. This may be a once-in-a-generation opportunity to have the ability to matter.
I just want to add on something that Noubar said because, well, first of all, I just met him backstage, and I'm like, this is a rock star. This is a guy who founded Moderna, that we can all be thankful for all the big breakthroughs. But it's also what makes you, in this type of environment, really optimistic about the opportunities. So we talk about the risks. I was just reading about a statistic where it was the head of AI at Stanford University who said there was a professor there that spent their entire career mapping one single human protein. And now they're about something like 20,000. I mean, I'm careful to say anything because I'm sitting next to him. Usually it's finance people, you can get away with it. But there are like 20,000 proteins in the human body, and they were able to map all of those within a year. So just think about the advances that ultimately can come, the opportunity from an investment standpoint, but also just the advances from, for mankind with the innovation that's happening in medicine.
Yeah, I was just going to add, I think the explosion of innovation is what makes us all optimistic, and the amount of private capital that now exists that's willing to make investments and make longer-term bets. And I worry about higher inflation, higher rates can make that harder, but the fact is there's a lot of capital on the sidelines that wants to invest in life sciences, wants to invest in AI, wants to invest in continued software development, wants to invest in decarbonization technologies. So for us, with our clients, we see an enormous desire and demand for private capital to fund these opportunities with longer duration and a recognition of the risks that are intertwined with making those investments. But I think that's what gives us optimism that there's plenty of capital on the sidelines to get put to work in these various technological developments.
We talk about finding opportunities in a risky environment. It's going to be a risky environment in 2024, isn't it? The U.S. election. How is it likely to move market sentiment and capital? John?
I have to say, I think if you study U.S. elections, presidential elections, typically they don't move markets hardly at all, maybe towards the end. You know, when the debate about who's really going to win or who's not going to win becomes more real. But for the vast majority of the period of 2024, I think the markets will largely ignore what's going on in the election until you get to a place where it becomes more real, the last 30 to 60 days. So, and I think that's the history of presidential elections in the market. So I think a lot gets said about it. I worry more about how it impacts U.S.-China relations, as an example, where we're seeing a reset, I think, in a quite positive way of the relationship between the two countries, an attempt now to try to have more dialogue. There's been a clear desire on both sides to more engagement. We're going to have, hopefully, a very good summit meeting shortly between the two presidents. I think the relationship is getting set to a better level, but 24 will be a riskier period for the relationship in the U.S. terms in particular because you have a lot of debate about U.S. policy towards China. So that may have more implication for U.S.-China relations, but I don't think the markets will be as attuned to the election vis-a-vis how it's going to impact asset prices.
Chow Kiat, speaking of U.S.-China, I mean, GIC is invested in a big way in China. I mean, how are you assessing the slowdown in the country? I know there are a lot of risks, but valuations are looking so cheap.
Right. So, but just, first touch on what John said, right? I mean, there are some foundational things that we need as investor, rule of law, governance and things like that. But really, when you look at a country, we would look at it, sort of three factors. Talent, capital, and market, right? So back to the US, it has all this, big, right, in place. It's the same with China, right? Do they have talent? Do they have capital? Do they have market? They have all these in place. They are going through an adjustment period, and they are, sort of coming up with, I would say, a new economic model that could power their growth going forward. Already in some sectors, we are seeing great advances, right? I think everybody know in the green, sort of sustainable sector, they are world-leading companies in China, and they have so much expertise, capacity, and the market to do that. So, I think as a global investor, we cannot afford, not to look at China closely, in fact, deploy capital. But the composition of the capital needs to adjust depending on how the market is, how the country is navigating. So I think that is where we are.
What's the composition looking like for you right now?
Well, we have sort of moved more to the green sector, consumer sectors. Those are seeing good pockets of growth. But because the economy is going through a lot of adjustment, we are cautious, right, on a lot of other industrial type sectors.
We know that about $160 billion worth has made an exit from China in the last 6 consecutive quarters. Jenny, your risk appetite for China?
Well, I agree with the points.
You're
talking
agree.
about. It's so interesting. A couple of things, right? You can't ignore the second largest economy in the world as a global investor, right? And you look at China, and again, they graduate more engineers every year than any other country in the world. The consumer portion of the economy is only 40% of the economy. Most developed countries, that's 60 to 70%. So huge opportunity if they can continue to get the economy growing. The consumer is going to spend more. So you look at that, and honestly, it's been knocked down so much that it's actually pretty cheap right now. But I agree, you have to choose your.
So you're a buyer. You've been buying?
So our emerging market team is definitely buying back in China. And they look at it and just say, at these prices, this is just a great price. Now, I also agree with John's point. I mean, one of the challenges in U.S. politics right now is, unfortunately, what the Democrats and the Republicans tended to agree on, the only thing was to bash China. And I think the realization, especially because businesses and others have said we've got to have a more constructive relationship, is there is an attempt with the current administration to improve that. And we're making progress. But you go into an election and sort of all bets are off. And so that's where it could hurt it. But I just came from Hong Kong, and somebody made the point, wow, there's so many American CEOs here. I thought there was issues with China. I said, well, you know, American CEOs recognize the need to have the second largest economy, that the market's important. And so that's where you're seeing engagement. It's the multinationals that are continuing that engagement in a constructive way.
Noubar, I'm curious to see your views on innovation in China. Is it thriving?
Well, I think certainly in the biotechnology field, there's been a lot of investment made, and there's a lot of kind of catching up that they're doing, and in some areas that they're leading. There are some big advantages. The way data is available and handled there is quite different than in the US. And there'll be certain areas where they will make persistent long-term bets that is very hard for markets to do in the US often, because the people just basically give up pretty quickly. So there's some advantages. There's some disadvantages because, again, navigating uncertainty is a little bit contrarian to a planful approach to developing economic growth. And so the question is, how do you create a simultaneous cultural compatibility between working on things you don't know will ever work and still working on them versus things that you know can work and you can do it more efficiently, more productively, and dominate. So I think that'll be interesting to watch over the years. The whole China-US conflict, in a way, affects the startup world, certainly in the semiconductor field, but also in the biotech field as well, because as these countries are taking more of a conflicting approach, you have to be careful about where information goes and access to technology and all that. And that has also impacted our world. So we have to be very careful. On the other hand, health security is a global phenomenon. We learned that you can have health security in some places and insecurity in others. So for companies like ours, it's very important that we not ignore certain areas of inconvenience, but actually figure out suitable ways to bring the most advanced technologies, but with certain safeguards in case there are disruptions in our ability to operate. So we're being very careful.
Let's talk about how capital should be mobilized. I mean, how do you get capital to areas which are needed? We talked about infrastructure, sustainable infrastructure. It's been quite difficult. What needs to happen? What would you like to see from governments, players, for capital to be headed in that direction to fill that gap, John?
Well, I would highlight for us, I think the decarbonization theme is a very good theme, and it's obviously critically important for, let's say, the emerging, developing markets, frontier markets, however you want to frame them. What's disappointing to us, and we've got a pretty significant investment paradigm around mobilizing capital for decarbonization projects in the emerging markets, but we need public sector money. We need development bank capital. We need something that we can multiply against, where there's a real first loss piece, because it's very hard to access the first loss capital in these markets, particularly in the current environment where, as has been said earlier, with a 5% risk-free rate in the United States, it's much easier and safer just to put your money there and not be too ambitious beyond that. So the environment's getting harder. I would say the development banks have been slow and small scale in the context of what they've allowed for in mobilizing that first loss capital. We've worked on a number of projects where we've gotten 8, 10, 12 times multipliers on top of development bank capital in renewable projects, in many of which are in Asia, in broader Asia context. But they're small projects, and we've not been able to mobilize enough capital to really make a dent in the $1 trillion+ a year that we need to mobilize. So if I had a request, it would be that we get more public sector capital that's willing to take first loss positions, that we as a private sector can crowd in behind and actually catalyze a lot of capital behind it. But it's been slow, and I think it's disappointing.
GIC's big on infra.
Yeah, that's a focus area for us. We now deploy up to about 20 billion a year in the infrastructure area. As John said, there's still a gap, right? And as I mentioned earlier, the gap is fairly big. We can get the MDBs involved and make many more projects bankable. The institutional investors today are really looking only at the tip of the iceberg, right? We're arguing over, is it 12% or 14%? Really, there's a whole, supply needed in terms of capital to address the infrastructure need, energy need of many, many countries. The good news, though, is that actually, at least in the renewable energy space, the cost curves are now commercially viable, in fact, profitable, right? That the cost curves have been coming down, so that's the best, right? Because that drives private capital directly into those sectors without the need for concessionary capital and other kind of de-risking help. So I'm quite hopeful that as more countries find that the cost curves are lower, more private capital will come on board. But certainly, you know, if we could have maybe the MDBs or governments themselves directly involved in making more projects bankable, private sector capital is ready to be deployed.
The fact is, it's actually easy to figure out where to deploy capital. Capital goes where it's treated well. So what does that mean? It's treated well, meaning you have transparency around the laws, where you can be predictable on the regulation, where you can actually get your capital back so it has free flowing. So those are all sort of the basic bar. And then people look at it from a risk-adjusted perspective, right? So you look at climate investment, and actually for a lot of the reasons, one is from the technological investments that's required, and two, because of the regulatory environment. It has been perceived that it's not, that you need some government assistance to come in, right? But I think there's three big categories that right now, I always say it's better to swim with the tide, right? So one, you mentioned, which is this supply chain, so let's call it China plus one or nearshoring, that diversification. And you look at, like, the prediction is that 28 of the 30 fastest growing countries are all going to be frontier markets. They're all the beneficiaries. It's Vietnam, it's Indonesia, it's the Philippines. They're all beneficiaries of kind of this China plus one supply chain. The second is climate, and I agree that, you know, the challenge again has been you need to have a buffer for losses. Otherwise, it's just difficult to make those investments. And then the final is, again, innovation, where there's just this convergence of these incredible technologies. I mean, you know, we talk about generative AI. Whenever there's new technologies, the first thing you do is just improve what you do, and then you get massive amount of innovation. But there's going to be some really, I think, exciting investment opportunities. And then my final point is risk-free investment now is 5%. So that makes all those other risky returns have to be higher. And so we're going to have to be thinking about where you can get those kind of returns. Climate just got more expensive to invest in.
But before I get your views, I'm not even sure whether there's actually risk-free investments. I mean, treasuries are not risk-free anymore,
you
right?
know what? I'm pretty sure. I always laugh when you know, the U.S. government, when they come to that budget and they're like, people aren't going to get paid, it's going to be an IOU. I'm pretty sure if you have an IOU with the U.S. government, you're not going to sell it at a very big discount. You're pretty sure you're going to get paid. So again, I don't think the issue is that people won't invest, that there won't be enough demand for treasuries. The question is, what is the price to get that additional investment? You know, the largest foreign investor is Japan at 1.1 trillion. We're going to add 2 trillion in debt to the U.S. Treasury. So I think that it's still pretty risk-free as far as how you'd measure it. It just probably costs you a little more.
I was going to say, I think it's risk-free, but I think the price is there's going to be a lot of pressure on the price. So that's going to, I mean, that is kind of the rate under which most things in the world get benchmarked.
That's right.
So, but, you know, I wouldn't characterize a lot of risk in that. I would just characterize the price is going to be more complicated, more challenging than it's been for the last 20 plus years.
Noubar, innovation. Where should capital be headed?
Well, I wanted to comment on this because it just harkens back to the beginning, but I want to make the following point. I think in climate and in many other areas, we're kind of hoping for some magical solutions to come about, but the financial markets cannot properly value the possibility of that. So instead, they float to the most predictable, adjacent, scalable solutions. And that I think markets can handle. I think where governments should be is actually creating an incentive for people to embrace uncertain solutions. Here's the point. Again, to come back, uncertainty is about unknown probabilities, risk is about known probabilities. I would argue that in uncertainty, there may be actually pretty low-risk solutions. We just don't know they exist yet. But if we price them as though they're the highest form of risk, which is the way Wall Street looks at it. So there's low risk, middle risk, high risk, extreme risk, and then uncertainty. Which means that when you're trying to underwrite an uncertain project, fusion, renewable, bio-based fuels, that seems so far out that you kind of want to use a 50, 60% discount rate, right? So 60% discount rate in 40 years for fusion means that $1 trillion value proposition is worth about $5 million today. Why would anybody invest in that? So, and what distorts that calculation? Answer, recognizing, first of all, that uncertainty doesn't mean extreme risk. It actually just means uncertainty. Go do the experiment. So I feel that governments can play a big role, and I'll explain what I mean. During the pandemic, what did this Operation Warp Speed do? A massive amount. Everybody fights over this to take political credit. I couldn't care less about that. The reality is that the US government said, you know what? We will send a signal. Anybody who can make hundreds of millions of doses of an effective vaccine, we will buy it at a fixed price. They gave a price signal, they gave an advanced purchase agreement, and they said to the regulator, last I checked, your family is dying too, so you act collaboratively so you can find a solution. Stop being an impediment to this. When everybody actually, it's true, when everybody actually joined hands and said we need a solution now, within 6, 7, 8 months, something that had never been tried before was tried and to an extent was helpful. Why I say that is you need the same in climate. I would urge governments not to incentivize low-risk deployable technologies. Markets can do that. They should send the signal, say anybody who can basically get rid of X amount of, the first billion tons of carbon that we can put away, we're willing to put a price on that. And that does more for innovators to actually vie for that prize than any amount of subsidy or this or that. Just create an expected certainty in the ultimate reward. That is missing in uncertainty. It's mispriced by markets, and therefore we'll keep working on adjacent solutions and hoping for miracles. That cannot happen.
Let's talk about mispricing.
That's well
yeah,
said.
I know, right? I want Noubar for president. Where are you seeing mispricings right now? Chow Kiat.
Mispricing? Not so much mispricing, but this sort of increase in the risk-free rate means, repricing for a lot of assets, right? Because it's just simple maths. The discounted cash flow, discounting at higher risk rate. So I think that is now working through the markets. You have all seen that deal volume has come down. So I think a lot of investors are re-examining, the stock that they have, right? Tend to them, recycle some capital. At the same time, the flow is happening. Not very big, but it's happening, right? I think the obvious areas are in credit, for example, that because there is capital shortage, that is giving, I would say, a return that's higher than usual. So there are some opportunities in that flow. The vintages, so-called, using private market language, will probably work out better going forward. So those are areas that I think you're seeing some repricing or mispricing.
So I would say, look, markets are pretty efficient. So I don't think it's mispricing as much as opportunity because of some kind of dynamic going on that isn't directly related to the value. And the area where I think that exists right now is in secondaries, secondary private equity, private credit, because you have a huge number of pension funds and institutions that own private assets. They're not getting the same kind of distributions they historically received. They have capital calls, and they're potentially overweighted in the category. So in order not to be kicked out of a fund because the top performing in these categories are significantly outperforming the bottom, so you don't want to miss your capital call, otherwise you're kicked out. They have to get rid of some of those assets. And so there was $6 trillion deployed in private equity. There's been about $150 billion deployed in secondaries, maybe $110 billion raised. The discounts right now, so you already repriced them, but the discounts are anywhere from 18 to 20% in private equity, real estate 22, venture, late stage venture at 60% discounts, and it's really about people needing to get this off their balance sheet, not about it being a bad asset.
Yeah, I was going to say I think there's 3 categories where there's debate whether it's mispriced or not, but there's heavy debate. One is equity risk premium, which at the moment is very, very low, certainly given the price of the U.S. Treasury, let's say. So there's a heavy debate about whether equity risk premium should be higher, given the risks and uncertainties we've talked about in the world. Two would be private market assets, which has been mentioned by Chow Kiat and Jenny, which I totally agree with. And I think the second, we just raised a big secondaries fund. I completely agree. The opportunity is there to potentially buy a lot of private assets at a big discount, but it's hard to unlock because people don't really want to sell them at those prices. So there's a heavy debate about what is the real clearing price, whether it's private equity assets or the legacy private credit that isn't the newer vintage, the stuff that's priced at kind of yesterday's prices. That's another big area. And then I would say duration in fixed income, right, which is a question around what is your view on where the Fed and the other central banks are going. If the Fed is really done and they're going to start easing sooner rather than later, you might have some opening up in duration. If the Fed is not done, has to tighten again, or is just going to stay at these levels for a fair bit of time, that's going to change people's perspective on duration. So I think those are the three areas to us that are really questionable in terms of what the real pricing ought to be.
Several minutes left. I just want to, we've been talking about how we're looking for opportunities amid a risky environment. Can we just go down the line to see your risk appetite now versus before the pandemic? Where are you with it? John, we'll start with you and then Chow Kiat.
Lower.
Low?
Lower. Lower.
Lower. How much lower?
Low, hard to put a number on it, but I'd say, given all that we've talked about, it's not a period to be particularly ambitious from a risk standpoint. So I would say, 70, 80% of par in terms of, if that was an index, in terms of our risk appetite. And I'd say, more importantly, our clients' risk appetite. Put aside our risk appetite, reflective of our clients' risk appetite.
Chow Kiat?
I would say maybe slightly higher than what John indicated, but we think that it's a 2-year game, right? In the next 2 years, there should be more of these repricing. This gap between seller and buyers will close, sometime involuntarily. So next 2 years will be very, very interesting.
Jenny?
I'd say lower, but even with that, I think that one of the things that we just learn over and over is you need a diversified portfolio because you never understand, you never see it coming, what that big risk is. And we were looking at data. If you missed the 10 best trading days in a 20-year period ending in 2022, you missed 57% of the return in that 20 years. So you think about that, you never can time it right. So even though I would say that, and our clients too, because everybody's trying to figure out, do you go longer duration now? How should we think about this repricing in the equity markets? But on the other hand, if you're sitting there with a portfolio, you have to have a diversified portfolio with some risk.
Noubar, I know you look at risk very differently from the rest of the gang here. I mean,
I want to avoid risk at all costs and embrace uncertainty. So I really
but you embrace risk. I mean, in a risky environment, because that's...
Well, I think if you embrace uncertainty, one of the advantages of uncertainty is it'll take a while to resolve. So you'll be out of the current market anyway. But if you actually go ahead in trying to convince people that something that is risky isn't, which is what most startups do, that I think is a futile exercise right now. I would also say there's opportunity we haven't talked about. I started my comments by saying I think we're in this kind of seemingly endless loop of pandemics that are infecting each other. If we're going to be in a period where the equilibrium is going to shift to a new equilibrium, the set of crises we're envisioning actually are opportunities for relatively low-risk investments in that they're new value pools. They're totally new value pools. So instead of competing in current value pools where people are struggling to keep their market share, actually, and AI is a great example of that. AI, to make things more efficient, is one use. AI to create totally unprecedented value pools and how you can actually lean into that, right? So you could either look at AI as high risk or high uncertainty. We look at it as high uncertainty and go try to find low-risk applications that create new value pools. That, I think, is in season in this environment. 5 years ago, it was too easy to make money. Nobody would bother with that.
One final question, 53 seconds to go, just down the line again. If you take a look at a longer-term perspective, what's key to your investment strategy? John, you can't take your time. You have 50 seconds.
I would say regulatory certainty and more political stability and regulatory certainty.
Chow Kiat?
Sorry, repeat the question. You say
If you take a longer-term perspective, what's
Right.
key to your investment strategy?
Yield. Right, in the long term, you wins out.
I'm going with diversification.
Governability. I'm really worried that if we don't find a new equilibrium, all this is for naught.
All rock stars. Ladies and gentlemen, please a round of applause for our speakers today. Thank you.